your stories,
your freedom.
The Peter Schiff Show.
Welcome, everybody. This is Peter Schiff here at the Peter Schiff Show on SchiffRadio.com. Welcome aboard, everybody. The number to call, 855-4SCHIFF, 855-4SCHIFF. We don't have a guest until the top of the next hour, so we have a full hour, so plenty of time to take phone calls before our guest comes on. So make sure and call and hop in the queue at 855-4SCHIFF. Well, the markets are off to a strong start as far as equities are concerned. The U.S. Dow Jones up about 100 points. That follows gains in Asia and in Europe. The dollar, of course, weakening, although off its early morning lows, mainly because the equity markets are off their highs from pre-open. Had the Dow Jones opened where it was trading based on the futures a few hours ago, the Dow would be up closer to 200 points, and so the dollar has gained back some of what it was losing when stock prices were stronger. But the dollar is weaker across the board. Pretty much every single currency is up against the dollar. The dollar index traded, I think, as low as in the 73.60s, not quite 73.50. I think there's some key support down there that ultimately I think we're going to break. Who knows, maybe as early as today. Of course, with confidence coming back into the stock market for the day, people are selling gold and silver. Gold's off about $20. Silver off about 60 cents. The markets were quite a bit lower on the open. I think gold was down maybe an extra $10. Silver was down about $1.20. So silver's cut its losses in half. The mining stocks, though, are still closer to the lows on the day. And, it is kind of crazy how much the mining stocks are down when the price of gold goes down. Every time gold goes down, they dump the mining stocks. But a lot of times when gold goes up, they don't buy the mining stocks. I mean, people still don't seem to understand, at least the traders here in the gold mining stocks, that even if gold dropped by $500 an ounce, $500 by 30%, all that would happen is that the gold index would be exactly where it was when gold was $500 an ounce lower. So why would the gold stocks have to get crushed by 30% or more if gold prices go down by 30%, when gold stocks didn't enjoy any upside for that last $500 increase in the price of gold? In fact, if gold stocks went down by 30%, in line with a 30% drop in the price of gold, gold would be around $13.50, and the gold stocks, the Huey, would be down at 400, which is where it was when gold was at $600 an ounce, which would mean gold would have more than doubled from 600 to 1350, yet gold stocks would have enjoyed zero appreciation. So I think at some point the traders are going to have to realize that a drop in the gold price from this level is not bearish for gold stocks. If gold only drops $100 or $200 an ounce, that is still extremely bullish given how low gold stocks are right now. I don't know what it's going to take to break that dichotomy, but at some point you're going to have to see gold stocks rising even as the price of gold goes down in order for this relationship to catch up, or gold stocks are just going to have to go ballistic with the price of gold. If the price of gold keeps going up, at some point they're going to have to go into warp speed to catch up to where they should be. But I think at some point it's more likely that we're going to see a pullback in the underlying metal prices, and at the same time we're going to see a rise in the stock prices. That's how I think you're most likely to resolve this disparity between where gold stocks are trading and where gold prices are. Because after all, what is a gold stock? A gold stock simply represents the future earnings of mining gold. And the higher gold is priced, the more valuable those future earning streams are, and you should discount that into the present. And with interest rates as low as they are, the present value of those future cash flows should be all the more valuable given the very, very low rate of interest. Now, interest rates are rising a little bit today, but not much. I mean, the 10-year yield is still about 2.1%, just over it, which is ridiculously low. No, I was watching on CNBC this morning when they're talking about the markets. See, they're still following this false paradigm. They bring these experts on there, and they're talking about the fact that they think the government is going to have to change its focus from deficit reduction to job creation and economic growth, as if somehow those two are mutually exclusive. If bringing down the deficit is anti-growth and anti-jobs, and that the way to create jobs and growth is to have a bigger deficit, and that is Keynesian nonsense. The only real way to stimulate the economy is to tackle the deficit now with massive cuts in government spending and combine that with deregulation and sound monetary policy, meaning higher rates. That's the only way to get legitimate economic growth. But if you continue to have this idea that, well, no, the economy is weak, therefore we need bigger deficits, therefore we need more government spending, the economy is never going to really recover. That is the box we're in that everything that conventional wisdom, and the wisdom is in quotes, says you're supposed to do is wrong. And so as long as we're going to have that idea that, oh, no, the economy is weak, so we need more government, we need more spending, we need more stimulus, then we never get economic growth. Again, there was another guy that was, I guess, co-hosting this show, the Squawk Box or whatever it is. They don't even have me. I haven't been on. I used to be on that show a lot. That's where they started calling me Dr. Doom on Squawk Box. But ever since all of my predictions came true, they haven't had me on once. See, they used to like to have me on when they would make fun of me. Now, the thing is, they still have other bears. They had Mark Faber on this morning, so they will have bears on there. They just don't want to have the bears on there that were regulars during the run-up, because I think they probably think I have too much credibility, or maybe I make them look bad because I was saying this on their air when everybody else was Pollyanna and talking about how great things were. So they still want bears on there, but they don't want bears that were on there when I was on there in bears, because they don't want to have somebody with that much credibility. But what happened, what this guy was talking about is that he's upset that all the people who have homes that have gone down in value, that they can't refinance, that they're stuck at maybe a 6% mortgage, even though the current mortgage rates are in the 4s, and that to really stimulate the economy, we need to allow these guys to refinance to these lower rates, because then they'll lower their payments and have more money to spend. But the reason that they can't refinance is because their homes, they have no equity. So they can't. Nobody will loan them money because it's a bad loan because there's no equity. And so what he's saying is that the government should step in and tell the new lenders that if they refinance somebody who has no equity and they walk away or they don't pay, that the government will make them whole, meaning the taxpayers will be on the hook for the losses. But what this guy really, really doesn't understand is what is the opposite end of that. So you have people that are now making mortgage payments at a 6% rate. If they refinance down to 4%, who loses, right? The loser is the banks. The banks that are currently collecting 6% only collect 4%. That means those banks are insolvent. They need that money to make up for all the mortgages that are in default. So if you lower the interest payments, that helps the borrower, you hurt the lender, and that means the financial institutions, the banks, are less solvent and in more need of government money or another bailout. Anyway, I'll continue this. We're running out of time. We'll be right back. Hey, make sure to call. We got plenty of open lines here at 855-4SHIFT. 855-4SHIFT. We're listening to the Peter Schiff Show on SchiffRadio.com.
The Peter Schiff Show. It's clear to just about Peter Schiff Show was last on the air. The national debt added another $7.89 million.
Luckily, Peter's intelligence is growing twice as fast.
That's incredible.
Welcome back to your source of sanity in an insane world. It's the Peter Schiff Show.
Welcome back, everybody. It's Peter Schiff at SchiffRadio.com. And taking some calls, 855-4SHIFT, 855-4SHIFT if you want to call. I was talking before the break about the idea of refinancing all these mortgages and how, yes, if somebody who's got a 6.5% mortgage, if they can refinance it to 4.5%, that individual now has more money to, I guess, spend is what all the Keynesians want them to do. But what about the bank that was earning 6.5% that is now only earning 4.5%? What happens to that institution that loses that income? That means the banks have less revenue. They have less capital. They're in a weaker financial position. They can't make as many loans to businesses to create jobs. They are more susceptible to needing a government bailout. There is always two sides to the coin. You can't simply say, yes, people benefit from having lower rates. Yes, but what about the person who is now going to suffer a diminished income stream? And look at the financial sector right now. Here are 5 stocks: J.P. Morgan, Citigroup, Morgan Stanley, Bank of America, and Goldman Sachs. What do those 5 stocks all have in common? Each 5 hit a new 52-week low today. 52-week lows. Even though the Dow is up 111 points and has never been negative all day, all 5 of those bellwether financials hit 52-week lows. Now, obviously, the financial sector is sick. It's weak. Imagine how much weaker it would be if all those income streams on all those mortgages were reduced by about a third. And these are the people who are paying the mortgages. Remember, they're stuck with a lot of non-performing mortgages. This guy's plan was to take the performing mortgages and make them far less profitable for the banks. So this is always the flip side of interest rates. It's a double-edged sword. You always got to think, who is the loser? Yes, somebody gains when interest rates go down, but who loses? Because it's just a transfer. Interest rates represent a transfer. Right? It's money that is paid from a borrower to a lender. So whatever the borrower gains by lower rates, the lender loses. And what you really have to look at is, what are the incentives? What happens to the economy based on these transfers? Anyway, let me go and take a couple of calls. First up is Kevin in Manhattan. Kevin, you're on.
Hey, Peter. Thanks for taking my call.
Thanks for calling.
Sure. Question about mining company investments. I mean, I was just wondering, do you think that the bigger mining companies with greater reserves are going to do better because as the price of gold goes up, all those reserves that they have are going to go up?
Well, in theory, I mean, but they're not. But yes, I mean, one of the reasons I like these gold stocks is because it's the cheapest way to buy gold, because they own gold. In fact, I think one of these days, sovereign wealth funds are going to start buying up these stocks, because you hear stuff like the Chinese will say they want more gold, but they don't know how to buy gold without driving up the price of gold because they need to buy a lot. Well, one way to do it is buy the miners, because then you get the gold that's in the ground. You don't have to buy the above-ground gold, which is a very short supply, and push up the price. Just buy out a mining company, and you get all their gold in just one transaction. So I think this is going to happen. And I think what's probably going to happen with some of these bigger stocks is I think they're going to start buying up. I mean, they're going to buy up more of the smaller miners, more of the exploration companies that have good prospects, rather than doing their own exploration. Because the cheapest way for the big gold companies to get gold is not to go explore for new gold and mine new gold. That's too expensive. Just buy it on Wall Street. Buy it on the stock market. And so not only do I think that's bullish for the sector, but it's actually bullish for gold. Because if there's less gold exploration, if big gold mining companies aren't looking for gold because it's cheaper to buy it on the stock market, then that keeps the supply of actual physical gold from growing. And that's bullish for the price. So I just think the fundamental story behind the gold mining industry is extremely, extremely bullish. And it's just amazing how few people have woken up to just how good the prospects are for this industry.
Right. And do you think U.S. mining companies, like let's say a Newmont Mining, is a safe company to invest in, or are they facing the threat of both nationalization and, let's say, windfall profit taxes?
Well, I mean, safe, it depends on how you look at it. I mean, is it there's going to be volatility. So, I mean, if somebody buys Newmont Mining, which right now it's at $62, can it go to 52 or 42 or 30? Absolutely, of course. So, I mean, from that respect, I mean, you can't buy it if you're not willing to take a risk that it goes down. But as far as nationalization, I mean, their mines are generally in places that don't have, I think the risk of nationalization is small. Although, how small is it in the U.S.? I don't know. I mean, I think of all the major economies like the U.S., Canada, Australia, where there's a lot of gold mining, I think the risk of nationalization is higher in the U.S. than in those countries. I don't know how high it is, but it is there. And but another form of nationalization that is not as overt is something called windfall profits tax. So the country could look at the success. I mean, Australia just did that recently. They proposed higher taxes on the mining industry. Sometimes the politicians, they see the mining industry making a lot of money, and it's ripe for the pickings. And so, we see that a lot more with the oil industry because the public usually wants to get back at the oil companies for high prices. And one way to do that is to stick it to them with a windfall profit tax, which is generally the worst thing to do when oil prices are high, because you don't want to take profits away from the oil companies, because that way you're not going to bring oil prices down, because that's the money that they need to get more oil out of the ground. So if you take their profits away, then the price of oil goes up even more. But I think that could be a pretty big, a honeypot for the politicians to raid. And of course, maybe the politicians will be able to vilify the gold speculators and the gold industry as gold prices go up, as there's high inflation. They might blame the problems on gold, just the way they shoot the messenger with S&P. So, who knows if they're going to increase profits on gold mining companies in the U.S., which would be negative for a company like Newmont. But, that's not my prime concern. I mean, and I think, and if you look at a stock, and again, I'm not giving any investment recommendations here. I'm just discussing these stocks in a general way. But, I mean, you look at a stock like Newmont Mining that's still trading at a PE of 13. I mean, it kind of is, think about other bull markets, big bull markets, and think about how high PEs tend to get when you're in a major bull market. Yet these PEs, to me, still seem to indicate fear rather than greed. But, hey, thanks for the call. Anyway, don't go away. We got plenty of the show coming up after the break. We'll take some more phone calls, and I've got some interesting sound clips to go over. We will be right back.
The Peter Schiff Show.
Hi, this is Peter.
We now return to the Peter Schiff Show.
Call in now, 855-4-SCHIFF.
That's 855-472-4433.
The Peter Schiff Show.
Welcome back, everybody. It's Peter Schiff here at SchiffRadio.com. And I want to play a little sound from another Nobel laureate. This is the winner of the Nobel Prize in Economics in 2007, Roger Myerson. And often we talk about Paul Krugman and how I think that, he needs to return his Nobel Prize. Well, I think Roger Myerson is proving today that he needs to return his as well. In fact, before, I played a sound from Krugman about his space aliens, nominating him for the Nobel Prize in stupidity. Well, I've got another candidate for that. This guy, Roger Myerson, who knows? It's going to be a close call. I'm starting to see that there's one thing that all these Nobel laureates in economics seem to have in common is they know nothing about economics. I mean, they basically have to flunk an exam in common sense before you're even eligible to get one of these Nobel Prizes in economics. But listen to what this guy says, that the solution to our economic problems is more inflation. He's saying that we don't have enough inflation, that we have an inflation deficit, and we need to create inflation, and this is how we solve our problems in America. Now, I guess you got to have a Nobel Prize to really understand and appreciate that and to come up with this kind of, this kind of solution. Because if you don't have a Nobel Prize, you're not going to think of something this brilliant. But anyway, let me play the first of these cuts, cut number 9.
I don't have a cut number 9.
Oh, you know what? It's on my slip, and I thought that meant it was ready. But you know what? It was the last edition, so we're going to have to play that sound probably in the last half hour of the program. Anyway, so I set it up now. I'm not going to set it up again, but I will play a little sound. Here's something from President Obama's CNBC. He said this on CBS yesterday about his low approval ratings, which are now at a record low. Let's play cut number 2.
This past week, your popularity hit a record low. What does that say to you?
Well, what it says to me is I'm the President of the United States, and when people aren't happy with what's happening in Washington, I'm going to be impacted just like Congress is. And, you know, I completely understand that. We expected that. That frustrates people, understandably. And you've got an unemployment rate that is still too high and an economy that's not growing fast enough. And for me to argue, look, we've actually made the right decisions. Things would have been much worse had we not made those decisions. That's not that satisfying if you don't have a job right now. And I understand that. And I expect to be judged a year from now on whether or not things have continued to get better.
So in other words, what President Obama is saying is that he understands he's not popular, but not because of him. You see, he's not popular because the economy is weak and people are taking it out on him. So, hey, it's not his fault that he's not popular. He's done everything right. It's just that he's unfairly being blamed is unpopular because the economy is weak. And what he's still saying is that, hey, if it wasn't for all the things that I did, things would be even worse. I wonder how long he's going to be able to get away with saying, hey, I know how terrible things are, but if it wasn't for me, they'd be even worse. I mean, at some point, you got to accept responsibility for the fact that things are still getting worse and they're not getting better. But this president is never going to accept any responsibility for his own actions. He's going to continuously look for excuses because, after all, if he's not popular, it can't be because of him. It can't be because the public doesn't like him. They just must be upset at him because the economy is bad. And it's not that they blame him, but, hey, he's the president, and so they're taking out their frustrations. Here, one more political clip I want to play, and this one is from Congressman Frederica Wilson, from the member of the Black Congressional Caucus, talking about how high unemployment is among African Americans and blaming it on racism. So here's the Congresswoman. It's cut number 8.
When you look at African American males, 40% of them are unemployed, those under 30 years of age. And I understand exactly that the entire nation must be involved in this recovery, but the black community is experiencing a great recession. That's what we're experiencing right now. And all of the growth in the past 30 years, we see it slipping away from home ownership with the middle class. It's slipping away from our hands. And it has a lot to do with many issues: racism, shipping jobs overseas, no access to technology. You know, the digital divide is there, and many of the new jobs, that's what it requires. So we have a problem.
Yes, and the problem is the policies that this Congresswoman and her colleagues have been pursuing all of these years that is creating the racism. I don't call it racism, but there is discrimination going on against African Americans, but it's not because of racism. It's because of the laws that make discrimination illegal. She's also talking about jobs being shipped overseas. Why are jobs being shipped overseas? Because the Congress, including this Congresswoman, are passing laws that punish employers for hiring Americans. And so the jobs are going overseas because regulation and taxation is forcing them overseas. And, of course, she doesn't mention the minimum wage law, which is adversely affecting minorities because there's a higher percentage of minorities in the lower skilled area, and so they are disproportionately impacted by laws such as the minimum wage, which make it harder and harder for people who have low skills to get a job and acquire skills. But again, getting back to the racism comment, it's not racism. One of the reasons that employers, particularly small employers, and I've talked about that at many times, one of the reasons that they try not to hire minorities, particularly African Americans, is because they do not want to be subjected to potential legal action resulting from racism at the workplace, either because they terminate them and they get a racially based lawsuit for wrongful termination, or because the particular employee is unhappy with the workplace environment and alleges that either the employer or a coworker is racist, and they do not want to have to deal with the legal liability and the costs associated with it. And so what do people do? What does a rational small businessman do who isn't racist at all, but he's worried about litigation and trying to minimize his labor costs and all his hassles? What does that rational, non-racist person do? They discriminate based on race. And why are they discriminating? Because of the laws that are meant to protect employees from discrimination. They backfire and they create discrimination. And so who gets hurt? The African-American minorities. They have a 40% unemployment rate. She's talking about young black male Americans. Why is that? It's not all racism. Of course it's not racism. It has to do with the laws and the taxes that have been passed by representatives exactly like Ms. Wilson. So if she wants to know why there are so many African-Americans unemployed, particularly young males, if she wants to know, just look in the mirror, because she is the reason. Anyway, let me go back and take some of the phone calls. First up is Brian calling from Beijing, China. Brian, welcome to the show.
Hey there, Peter. Thanks a lot. I had two questions. My first one, it's about mining stocks. I know you've already talked a lot about it. I remember you saying that you had about half of your personal portfolio in mining stocks. So I thought you'd probably be the right person to ask. I was listening to an analyst on Financial Sense News Hour the other day, and they were discussing their theory that I guess that the reason the stocks haven't gone up is because management has been constantly diluting the shares.
No,
I guess they've been.
I don't think that's the reason. Just look at the PEs. I mean, the PEs have come down quite a bit. I mean, I remember when I was buying these stocks years ago, the PEs were quite a bit higher than they are now. So I just don't think that the stock market is reflecting this, because the idea is that gold prices are going to fall. The gold investor is looking into the future and seeing a collapse in the gold price. And so they don't believe that the earnings are sustainable. And so they're not building in that sustainability into the stock price. And again, that's an indication of skepticism and a wall of worry, not a bull market. Anyway, we'll be right back. We've got a few commercials. I've got that sound coming up after this break, so don't go away.
The Peter Schiff Show.
Do you take Viagra? What if
Obama, Secretary Geithner, Madam Pelosi, and all of the socialist econ professors across America.
We're sorry. Peter Schiff is back on the air.
Welcome back. This is Peter Schiff here at SchiffRadio.com. And I think Brian is still on hold from Beijing talking about gold stocks. And, yeah, I mentioned I have about 50% of my personal portfolio in mining stocks. And, it could be more by now. I don't, it's not exact. But I haven't been buying a lot of gold stocks over the past few years. I have added to my positions, but the gold stocks have just outperformed the non-gold stocks. And so that's kind of what I've done. Although at one point, if you go back to 1999, 2000, 2001, so for a while, gold stocks were almost the only stocks I had, because they just seemed so cheap to me. But then I started buying other stocks along the way. And, the gains that I had in gold stocks, the biggest gains came between maybe 2006 and, 2002 or 1 and 2004 or 5 or 6, something like that. Because it really, the last few years, there haven't been any spectacular gains. I've had some stocks that have gone way up, but overall, the bulk of the gains in the mining sector took place earlier in the last decade. But I still think we got some big gains coming up. That's why I still hold all these stocks. Plus, I don't want to sell them because I'd have big capital gains taxes. So I don't want. That's part of it too.
All right. I had one more question as well, if you got a sec. This is actually this is kind of old, I guess a recurring thing that you discuss on your show. But there's a certain, I guess, money manager who you generally don't want to name. I guess in 2008 he went after you. He criticized your whole investment scenario. You know who I'm talking about.
Yeah, I know who you're talking about.
Okay, yeah. Most listeners probably know as well, but I guess not to name him. Me and a buddy of mine were wondering, given how severely he went after you. I mean, he really did go after you pretty severely. Like, you've been very, I guess in response, you've been very careful, I guess, not to attack him. Me and my friend were actually just wondering, do you guys have like a personal relationship that you don't really want to?
No, I mean, the main reason I don't want to use his name and talk, I just don't want to give him any publicity. I mean, I figure any publicity is good at this point, and he tries to get publicity off of me by using my name, and he tries to criticize me and hope people will look at him. But I did point out that his investment performance is horrific in 2009, 2010, and 2011. I mean, absolutely abysmal. Probably, as bad a record as anybody can have. And, the only reason he did okay in 2008 was because he was in cash mainly. And so by comparison, he did well because anybody who was investing did poorly. But he's done very poorly subsequent to that. I'm assuming he did really poorly before, which is why he manages such a small amount of money. But I just don't, the reason if he would have gone after me in a more professional manner, I would have had a little bit more respect for him, but he lied about a lot of things. And again, part of the problem is I can't really defend my track record without stepping afoul of the regulators. So it's very difficult if somebody says, hey, here's a client who lost a lot of money. I can't bring up a client that made a lot of money. Even if I have 100 clients that made money for every one that lost, I can't even talk about that. And I'm not even saying that is the case because I can't even talk about it. So it puts me in a situation where the best thing to do is ignore it, because if I really try to defend myself, I might end up getting myself into trouble, even if everything I'm saying is true. I can't talk about any success that my clients may have had, even if it's true. Right? I can't talk about it because it's a violation of the security laws. And again, I think these laws were written to protect the really big firms who have done an awful job. See, they don't want small firms who maybe have done a really good job from advertising that fact, because it might cost some of the bigger companies to lose some of their clients. So I think they created these security laws so that anybody who does a good job, they can't say anything about it. And so therefore, if you've got these huge firms that are doing a really bad job, it makes it harder for the little firms to take their business away, because you can't promote your success. But anyway, thanks for the call. Hey, I want to play this sound that I alluded to earlier from this Nobel laureate who says that what we need now is a lot of inflation, and that's going to make the economy better. So here is cut number 9.
I think the best way to restart the economy is through a relaxed relaxed monetary policy to stimulate the economy and to get, in some sense, we've got an inflation deficit. Standard rule, everyone agrees the Fed should use monetary policy according to predictable rules, but I'm not sure we have exactly the right rules. We tend to look at current inflation. We've had several years of deflation, asset deflation, and very little inflation that's been much less than anticipated. In some sense, we have an inflation deficit of 5 or 6 percentage points.
So we have an inflation deficit, right? We don't have enough inflation. I mean, what is this guy, nuts? Oh, yeah, I guess he is, because he's got a Nobel Prize. That's part of the requirements for having a Nobel Prize, is you lack any common sense whatsoever. Well, first of all, not everybody agrees, but he's saying what we need is a relaxed monetary policy. Well, haven't we had that? I mean, how could you get any more relaxed than 0% interest rates? If a relaxed monetary policy were the solution, we would have solved the problem years ago, because we're completely relaxed. I mean, this thing is crazy, but it gets better. Here, cut number 10.
We need to be able to restore the price level to the path that it was on, in some sense. That would call for the Fed to keep buying U.S. government debt until we get enough inflation to get us back onto the price path that we were on before 2008.
Now, tell me about that inflation then. How much inflation do you think that the economy can cope with?
We've had some. We should be normally aiming for a 3 or 4% inflation rate. We've had a couple of years of 0% inflation rate. So a couple of years of 8 or 9% inflation rate is good for the economy.
So a couple of years of 8 or 9%. First of all, he thinks that we should have 3 to 4% inflation every year, which is a lot of inflation. I mean, most central banks that target inflation try to keep it below 2%. This Nobel laureate thinks that ideally that money should lose 3 to 4% of its value every year, which would be a disaster. Because, again, remember, Nixon had wage and price controls when we got to 4%, and this guy thinks that we need 4%. But because we didn't get 3 to 4% for a couple of years, he thinks it should be 8 or 9%. 8 for a couple of years? I mean, if we had 8 or 9% inflation for 2 or 3 years, you know what that compounds to? I mean, if the economy wasn't already in enough trouble, try telling people, hey, you know, we're going to jack up the price of food another 20 or 30%, the cost of gasoline another 20 or 30%, the price of food, the price of health care, clothing, college tuition. I mean, this is insane. This is what we need. This guy's got a Nobel Prize, and he's saying we need 8 or 9% inflation. But you know what? It's already there. It's already 8 or 9% inflation. That's why the economy is so weak. We got all this inflation, but the government is lying about it. So you know how much inflation we would actually have to have before the CPI actually registered 8 or 9%? It'd probably have to be 20, 25%. I mean, it would be unreal. Here, I'm just going to play the final cut, number 11.
So quite clearly you're supporting QE3.
Yes.
Now, the governor of Texas, Rick Perry, says that QE3 would be treason. What do you make of that?
I think he is absolutely wrong, and dangerously in the wrong direction. I think a patriotic governor of the Federal Reserve System should serve the country by buying U.S. government bonds, thereby retiring much of our debt outstanding, and do so until the inflation rate has edged up above 5%, enough years to get us back on the path.
Okay, so a patriotic Fed chairman would destroy the value of the dollar, right? Monetize debt with abandon, run money off the printing presses, get inflation up, wipe out the value of the middle class, wipe out their savings, cause a big increase in the cost of living, collapse our standard of living. And this is what a Nobel Prize-winning economist thinks should be done. You know, earlier in this interview, they were talking about Libya, and they wanted to know if now that they were getting rid of Gaddafi, you know, would he accept an invitation to go to Libya as an economic advisor to help them with their economy. I mean, you know, that actually might be a step down from Gaddafi. This guy might even do more damage if he comes in with this kind of nonsense, with this kind of monetary policy. I mean, come on, give the people of Libya a break. The last thing they need is this Nobel laureate coming over there spewing this nonsense about how inflation and paper money and money printing is what we need. You know, what they need over there is what we need. Less government. We need fewer economists like this guy. We need production. We need savings. We need higher interest rates. We need sound money. You know, we need Austrian economics, not anymore this Keynesian witchcraft, which is the reason the economy is so sick in the first place. Hey, anyway, don't go away. We got a great guest coming up after these messages. Stick around. You are listening to the Peter Schiff Show here at SchiffRadio.com.
The Peter Schiff Show. You can always...
You make no friends in the pits and you take no prisoners. 1 minute you're up $500,000 in soybeans, and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on!
You are about to enter the Peter Schiff Show.
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on.
Call in now. 855-4-SHIFT.
That's 855-472-4433.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories,
your freedom.
The Peter Schiff Show.
Welcome back, everybody. This is Peter Schiff here at SchiffRadio.com. Hour 2 underway now, and my guest, David Murin, who's trying to call in from Turkey. We're having some problems on the line, so in the meantime, I will grab a quick call. Next up is Durson calling from Dayton, Ohio. Durson, welcome to the show.
Thanks for taking my call. So my question is regarding renminbi. And I was wondering if gold is going to continue rising against the renminbi.
I think so. I think that as long as the Chinese monetary authorities maintain the undervalued RMB, if they keep trying to peg their currency to the dollar, that means they have to keep printing RMBs and creating inflation, which means that the RMB will continue to lose value against gold. Now, I believe that when the Chinese come to their senses and allow that currency to rise sharply, at that point, and only at that point, will the currency begin to gain back some of the purchasing power it lost. But until they do that, I think gold's going to continue to rise in terms of RMB.
There be a permanent loss in purchasing power in renminbi, even if the Chinese allow?
Well, it will be a permanent loss relative to what the RMB would have been worth had they not had that policy. But at some point, the RMB will gain against gold, and it might have a big gain. But wherever it settles up, it will be at a lower value relative to gold than it would have otherwise been had the government never pursued this policy. Because real purchasing power is being lost that will never be recovered, because it represents all the goods that Americans were able to consume at the expense of the Chinese.
Even from these levels, like the current price of gold with respect to renminbi right now is still.
Yeah, well, I guess I expect that they will continue to print RMB for quite some time. Maybe another couple of years, and maybe they'll finally let the currency go up. But wherever the RMB ends up, it's going to be at a lower value than it would have been had they never done it. Now, is it possible that we can see RMB appreciate relative to where gold is right now? Yes, it could. But it would have appreciated more if we hadn't been on this policy. But I don't know exactly what gold is going to be at in RMB, and if over the next 3 or 4 years the Chinese might actually be losers by buying gold, that maybe they would be better off if they stuck it out with the RMB. I don't know. I think in the short run, on paper, the Chinese who are in gold will be better off than those who are in RMB. But how it ultimately ends up, a lot of it depends on how long the Chinese wait to pursue the correct monetary policy.
RMB becomes the world reserve currency. Wouldn't that help the RMB?
Yeah, it might be the world's reserve currency, and it might be that because it's backed by gold. But the question is, where will gold be? Will the RMB gain against the dollar? Absolutely. Well, no question about it. I think it'll gain against the euro ultimately. I think it'll gain against the yen. I think it's going to gain against a lot of fiat currencies because those currencies are going to be printed in large quantities as well. But will it ultimately gain against gold? I don't know. Probably not, especially if gold is remonetized. Because I still think gold needs to be a lot higher if it's going to, resume that role.
Yeah, thanks for answering my question.
Yeah, sure. Thanks for calling. Apparently, guest is on the line. Anyway, so David Murrin, he is the Chief Investment Officer of Emergent Asset Management. They specialize in the emerging markets. They're active in hedge funds, also private equity, in some farmland in sub-Saharan Africa. So some very interesting investment opportunities that they work on. David has a background in geology. He also was in the oil and gas industry, but has been trading for, I think, about 20 years. David, welcome to the show.
Thank you very much indeed for the introduction. A little over-generous, I suspect.
Yeah. So now you're in Turkey right now. Where's your home?
I live in the UK, but I'm very mindful of the fact that the UK, Europe, and US are all the old world.
Yes, and that's...
In fact, when you look at these emerging market countries, they're the new story.
Yeah, I mean, the old world, unfortunately, Western Europe, the U.S., we're mired in debt. That's the consequence of generations of social welfare states where politicians have promised big benefits to get votes, and now you have these countries that are laden with debt. They've destroyed a lot of their manufacturing and have resurrected these phony service sector economies. Meanwhile, you've got an emerging world where you don't have these problems, you don't have debt and unfunded liabilities, and you have production and savings, and that's where I'm investing, and obviously you've come to the similar conclusion.
Yes, I mean, I think I wouldn't also just go back a couple of generations and blame current policies for 20 years, because it's much bigger than that. Mm-hmm. And in the book that I wrote, Breaking the Code of History, I kind of elucidate this idea that empires, as their biggest social structures, have cycles. And they're young when their demographics are expansive, so they take risk, and they expand, and they need resources, so they have, policies commensurate with acquisition. And then they mature at some stage after taking over a region or a larger area. And then in maturity, they have very interesting social balances that shift. And in decline, essentially, their demographics are very poor. And when demographics are poor, it's very, very hard for any system to actually flourish. And so if you look at Europe and you look at the U.S., essentially the core that built the system, that the European immigrants that went across over 200 years ago and started that process, their demographics are equally as poor, disguised by perhaps immigration across border from Mexico and Latin America. But essentially Europe and the US have very similar characteristics, and America is the last of the Western Christian empires.
Yeah, and how far in the collapse do you think we are right now, or how many more years do you think the U.S. has before it really crumbles?
I think you're in the absolute. People say to me, "Why are you looking at 100-year cycles?" And when they can take years to play out. And I answer quite simply: earthquakes take years, maybe hundreds of years, to build up their tectonic pressures, but they release in seconds. And geopolitical events are very, very similar to that. And I think America is right at that moment where that's what happens. It loses power incredibly quickly. Mm-hmm. And what's relevant is that I kept asking the question of, is it the challenge of the youthful system that actually knocks the old system off its perch? Or is it the old system that creates a vacuum that the new challenges move into? And it's actually the latter. And the one thing that America has at its disposal is to be aware of where it is, because denial at this stage is just prevalent across so many historical examples. And if America can really understand where it is, there are strategies it can take that can actually slow its decline. But at the moment, everything it's done has actually accelerated decline, created a bigger vacuum, allowed China to move into that space and made the world a much more dangerous place.
Mm-hmm. So between the U.S. and Europe, where do you see the bigger problems?
Well, okay. Let's look at them. They're two different parts of the cycle in some ways. The old European systems around France and Germany, especially Britain, we lost our empire. Britain lost its empire in the 50s. The legacies disappeared with Suez when America took the baton. And so what you've seen in Europe is a process of forced reformation, amalgamation of smaller countries into a bigger unit that it thinks compete. But it defies the simple laws. That's what happens in regionalization. And regionalization is the beginning of a cycle where demographics allow one-centered group to agglomerate others around it. And the demographics of old Europe are appalling. So it'll never work. I mean, the experiment of Europe, in my opinion, is a failed experiment simply because of the mechanics of agglomeration don't work with good demographics.
Anyway, we've got to take a quick commercial break, but we'll get back, and I want to get a verdict, U.S. or Europe, which is in worse shape, and we'll talk about where you are investing when we get back. You're listening to the Peter Schiff Show here at SchiffRadio.com.
The Peter Schiff Show. It's clear the show was last on the air. The national debt added another $7.89 million.
Luckily, Peter's intelligence is growing twice as fast.
That's incredible.
Welcome back to your source of sanity in an insane world. It's the Peter Schiff Show.
Welcome back, everybody. It's Peter Schiff, and on the line with me from Turkey is David Murin. And so, David, what's the final verdict? Who's in worse shape, the U.S. or Europe?
Well, because Europe doesn't project power, essentially the U.S. does. It has far more to lose as it goes down the Swanee, simply because it's influencing the world as an empire. And so, your currency denominations change, power projections change, and so I think America, they're both in really bad shape, but America will have a much greater impact in the world.
Yeah, I agree, and plus, we rely so much on the reserve status of the dollar and the fact that so much of what we consume is imported and paid for with a printing press. Europe, for all its problems, is still, self-sufficient in that their trade balances, their current account is in surplus. If you look at all of the nations collectively, so I think we're on a much higher pedestal, and we have a much further way to fall. But enough.
Much more. Yeah, exactly. It's a good way of describing it.
And I think Americans are going to be in for a rude awakening. I think we have a very inflated opinion of ourselves and our role in the world, and we're going to have to get used to a much bigger decline in our standard of living. I think a lot of people in Europe, in many places, are already used to a lower standard of living, and so this is going to be a real, cold water in the face for America to really understand what our place in the world is. But enough about the falling empires. What about the rising empires? I mean, where do you see the greatest opportunities? Where are you investing, and who are the new dominant players to take over the thrones?
Well, there's a couple of things you've got to bear in mind. First is the real destruction of the West is, in my mind, stagflation. It's negative or neutral growth with high inflation rates imported from the Chinese expansion and raw commodity cycle. And so just so people really understand that, it's not like the 70s. It's a completely different paradigm, and it's going to bring some huge challenges to be involved in any part of the Western economies and hold your own value in terms of what you've earned and and keeping it. So you've got to go overseas, and you've got to go to places where essentially I think the growth rates match the global inflation rates. And some of the areas which obviously stand out. Should you go to China? No. You will never make any money in China because in the stage of expansion of empire, the people just don't let it happen. They will not let a foreigner make any money whatsoever from their expansion. So you can forget China. India is very likely. I think that's interesting with its rule of law and English-speaking people. But they're very sharp and very industrious, in many ways sharper than we are, I'm afraid to say. But I think a great opportunity is Africa. Africa has the best demographics in the world. It has resources. It has growing demographic trends, and it's also got a bar to entry. So Africa is probably my favorite place to really make gains.
Well, Africa is a big place. There are a lot of countries there. I mean, specifically, where in Africa are you investing?
Okay. So let's divide Africa, the southern part of the Saharan Desert, and the Islamic world is not an investment target for me. And in fact, the countries that border that desert band, I think, are very dangerous simply because of the resource scarcity conflicts which could come about. But if you go further south and you go to South Africa and Mozambique, and you go to places like Zambia and you go to Tanzania, that whole band of Botswana, they're very stable. They've got great demographics. And everywhere you go, you see opportunities for growth, whether it's mobile phone systems, infrastructure, just simple shops and expansions. There are really, really impressive places to go to.
Yeah, I mean, are there publicly traded companies that can be invested in, or is all of this for private equity to try to get involved in African opportunities?
There's a combination. There's a combination. There are publicly traded companies that you can go to. But, it's very interesting watching the growth of an area like that because the real growth patterns happen in the smaller to medium-sized companies which haven't quite reached listing yet. And so if you can find vehicles and people that can take you into the private equity arena, I think that's where the greatest opportunities exist. But again, that's something that's harder to do. And things that are hard to do often make you greater returns by simply the bar to entry is higher.
Yeah, what do you think? What are the exit strategies for the private equity? Is it just simply to generate income, or is there, who would be the buyer for some of these?
It's interesting because, having been an investor in Africa, Europeans have been a bit slow to go to Africa. Americans have been, I think, quite alert to it. The Chinese and Indians are very interested and deeply ensconced just simply because of their resourcing. And so as that process increases, I think if you build anything in Africa, the most likely people to buy it from you are Chinese, Indians, and Asian countries and groups which actually wish to have a stake in that expansion.
Yeah, and how much can you trust the governments there? I know, part of the worry is confiscation. I mean, if you build something up, is there going to be some, the government going to take it away? Are they going to nationalize it? Is some, is there?
I've got to laugh because how much can we trust the British government, the European government, the American government? I mean, 15 years ago there was a big gap between trust and delivery. And in fact, I think there's more integrity in many African governments as they expand, and that's saying something, than actually we find in our Western leadership. So the bands are much narrower. As far as confiscation is concerned, I think that's unlikely for the countries in SADC. I mean, Brazil did something interesting where they sort of forced people to share 51% ownership of all agricultural companies. But they're much further down the line. They're more like the Chinese in their own region. They're developed. They've got their own nationalistic traits, so I don't think we'll see those develop for a decade in Africa.
What are you thinking about South Africa? There are a lot of South African companies traded around the world. A lot of them trade here in the U.S. I mean, what's your feeling on South Africa?
But South Africa is a first world country in terms of infrastructure, and it's going through a shift, in terms of leadership in the segments of the society which actually dominate. What's interesting is, yes, you've got, for example, the youth movement in Bulema, and it's quite radical, and yet at the same time you've got the balancing of the growth of the black middle classes. And the big question in terms of revolutionary characteristics are a huge number of poor people and a few rich people, and the bigger the middle classes are, the greater the buffering against those changes. And so I still view South Africa as stable. It's coming up to perhaps one of the biggest challenging points since the shift in power in Mandela, but I suspect it will actually come through it far better than people think.
Yeah, because some of the South African, the big mining companies that are trading over here have been among the worst performing mining stocks compared to mining stocks in Australia or Canada. We just haven't seen a lot of growth. A lot of that have to do with the labor unions and some of the pressure they've been putting on these companies.
Look, I mean, I think obviously you look at Zambia and you look at all the copper that goes to China and the whole process. I think their business protection mechanisms are not as sophisticated as they are in Canada and Australia, and they're still having to learn. They're coming from an area, a way of life that sort of, it was a decade and a half behind our Western values and organizational processes, but they're changing very quickly. I mean, if you go to Namibia and you wish to go and see, there are 2 million people in Namibia. It's on the west coast of Africa, just north of South Africa, and they have an agricultural department in the government that's just so impressive. And so they are catching up in all areas, and I think the speed at which they catch up to global values will surprise people.
Well, hey, I really appreciate your taking the time out of your day to call in and talk about what's going on. And, I might like to talk to you further off the air about getting into some of these opportunities, because we're really not investing much money either personally or for clients in the African continent other than some stocks in South Africa. And I would like to explore some of those opportunities, because I do believe that there is some opportunity there that we're missing out on, and I would want to take part in it. But anyway, hey, again, appreciate your coming on the show. Everybody else, stick around. We've got another full half hour coming up with the Peter Schiff Show here on SchiffRadio.com.
Hi, this is Peter.
Now return to the Peter Schiff Show.
Call in now, 855-4-SCHIFF.
That's 855-472-4433.
The Peter Schiff Show.
Welcome back, everybody. This is Peter Schiff here at SchiffRadio.com. And before I play in the additional sound, I want to go quickly to the phones. I've got Steve in Pompano Beach, Florida, who's been waiting for the better part of an hour. Steve, thanks for your patience. Welcome to the show.
Thank you very much, Mr. Schiff. It's been a pleasure to hold for you, the guy who predicted the 2006 financial crisis. And speaking of which, that's actually what I want to talk about today. There have been a lot of people that have claimed to predict it, but no one as accurately as you. And I know I didn't come here to be dead horse. No, you've interviewed some other people who talked about the financial crisis coming, like Gerald Talente. But I wanted to ask you about someone I never heard you talk about before. Now, I know you've interviewed Mr. Kiyosaki, but there is someone else who worked for Rich Dad Poor Dad who published a book under his name by the name Michael Maloney, who is a very good technical analysis. Now, I'm not here to promote him or anything, but I just want to know what your opinion was on him. He runs a company called Wealth Cycles, which tries to educate people about the Federal Reserve and so forth.
I really have no opinion. I really have no opinion. I'm not familiar with him or his work.
Okay. One of the points that he did make, though, which I did want to ask you about, was he said in 1980, right after the Hunt brothers supposedly cornered the market, that when gold peaked at $850 and silver peaked at $50, that it accounted for all the M3 in existence, plus all the revolving credit. And if that were to happen again, that could mean even though gold, won't go forever, it could be $10,000 to $15,000 an ounce, whereas silver could eventually go to 1/10 ratio of 1,000. I was curious if you ever looked at it in those terms as to that kind of technical analysis.
No, I mean, I haven't. I mean, those seems like, pretty astronomical numbers. And I don't know, a 10-to-1 ratio gold to silver. I mean, that would be, very rare to get silver to be that valuable relative to gold. I mean, obviously nothing's impossible, but I mean, I'm looking for more of a 20-to-1, maybe 15-to-1, maybe at the peak, potentially at best, for silver. But I don't know, how high the prices are going to go. I mean, I don't know that they'll get as high as $1,000 silver. I would hope not, because that's not going to happen without real runaway inflation, which I hope we can avoid. But can we see $100 silver? Sure. Can we see even $2? Yeah. I mean, I think it's probably going to happen. I think you're going to see bigger increases in gold and silver prices before the U.S. Does anything to prevent massive, runaway hyper-type inflation. But we're going to have to be in a real crisis before there is any decisive action taking to avert further damage. I mean, we're just going to continue to borrow and spend and print until we're in the midst of a crisis. And hopefully we prevent an even larger crisis by finally doing the wrong thing. But, hey, maybe I'm just an optimist,
Oh, well, I certainly agree with you on that, but it could happen supposedly in a deflation environment. I mean, supposedly M3 right now is collapsing, even as Ben Bernanke trying to print a whole lot of money with M1. But, I mean, supposedly it has happened in the past, like in the Great Depression, where
I haven't seen the M3 figures because, we don't get them officially anymore, but I know M2 has been rising sharply in double digits over the past few months. So we are getting a pretty big increase in money supply.
Based on information I've seen from Shadow Stats.
Yeah. All right. Hey, well, thank you for your patience and for calling in. Hey, I wanted to play a little bit more sound, this time from Stephen Reich, who is Morgan Stanley's Asian non-executive chairman. Some years ago he was pretty bearish, so they shipped him off to Asia to kind of take him out of the spotlight. So, of all the Wall Street type economists, I've got some respect at least for Stephen Roach. But here I'm going to play some sound where, again, even Stephen Roach does get it wrong. In fact, I wrote a commentary one time ago called "Even Stephen Roach Gets It Wrong" on. So, he makes mistakes too. And, he's the best that they've got over there on Wall Street, or just about. And even he says some things that I think are foolish from time to time. And here is an example. So first I'm going to play, this is a CNBC interview, cut number 3.
We do have this ideological debate in the Congress and in the economics profession. You're either a Keynesian or you're an apostle of Frederick von Hayek. You want to provide open-ended stimulus for everything. Or you want to delever. I think we've got to look at what the problem is. And again, I go back to the consumer, overly indebted, saving short, and deficient on jobs. I think that's the menu of choices we need to consider. Can we do debt forgiveness, as we did in the Great Depression, to get these debt ratios down, whether it's mortgage or other types of debt?
So, in other words, what he's advocating is that we forgive debt, which would send a tremendous moral hazard, create a very moral hazard for a future. We don't want to forgive debt. But, yes, he is right. Consumers have too much debt, and we need to allow the debts to be liquidated. We need to allow consumers to file for bankruptcy. We need to allow consumers to go through the foreclosure process or things like that. We don't want to reward the bad behavior that built up the debt. But, yes, the debt needs to be liquidated, and the lenders need to suffer losses. Of course, Roach would probably like to see the losses paid for by the government. Well, where's the government going to get the money? Well, it's going to have to take it from the very people whose debt is being forgiven in the form of either higher taxes or higher inflation, which diminishes their purchasing power. But here, Stephen Roach is correct, and he does understand that we need more savings. But, again, he makes the Keynesian mistake of thinking that we need more savings, but we cannot reduce spending in the process, which is impossible. Here, listen to Stephen Roach with that contradiction in cut number 4.
Can we help consumers rebuild a savings cushion? We're not asking them to stop spending, but what types of incentives can we also give them to get better returns on their saving? They need saving. They're older and close to retiring, as you and I painfully know. And thirdly, there's the jobs issue. We keep hearing about jobs in Washington. We keep hearing it's our number one priority. What are we really doing to get out there with a massive commitment to create jobs for unemployed and underemployed Americans. I think those are the three items on the agenda that need to be addressed and elevated dramatically now.
So two things. First of all, Stephen Roach says we're not asking Americans to stop spending, but we need them to increase their savings. How? How is it possible? I mean, maybe if you win the lottery, right, you can increase your savings without cutting back on your spending. But unless you get a huge raise, how can you save more without spending less? I mean, you cannot spend and save the same money. It's one or the other. But, of course, he can't give up that Keynesian ghost. He's got the one thing right. We need more savings. But he somehow wants to magically get to more savings without cutting any of the spending. You can't do it. And, in fact, see, it's the current consumption that is the problem. The reason we need savings is because we need resources freed up for investment. So we need consumers not to spend. So the resources are there for investment and job creation instead. So more savings necessitates less spending. It's the underconsumption. It's the lack of spending that generates the real savings that gives birth to the economic growth. I mean, what Stephen Roach really needs to do is get a copy of How an Economy Grows and Why It Crashes and read it and understand the issues, unless maybe he understands it, but he figures, hey, that real understanding is not ready for primetime TV, and maybe he feels that his hands are tied as a representative of Morgan Stanley, even if he is way out there in Asia when he is on TV. Maybe he has to speak in ways, that maybe he's being censored. I don't know. Maybe we could give him the benefit of the doubt there. But anyway, hey, we got a commercial coming up. I want to just continue commenting on this again and then take your phone calls until the end of the show. You're listening to the Peter Schiff Show here on SchiffRadio.com.
The Peter Schiff Show.
Ever wonder why government... President Obama, Secretary Geithner, Madam Pelosi, and all of the socialist econ professors across America.
We're sorry. Peter Schiff is back on the air.
Welcome back. The last segment is here. And anyway, I want to just comment a little bit again about the Stephen Roach piece on, he's saying we need jobs. We need job creation. We do. But we're not going to get that with a government program. I mean, people have to understand there is no government program to create real jobs. I mean, can the government hire people? Yeah, of course they can hire people, but where's the money come from to do it? They've got to destroy more productive private sector jobs. Where do jobs come from? Right? I've talked about this before. They come from entrepreneurs who are trying to make a profit. That's why they hire people, because by hiring people, they make more money for themselves. But what do you need to create a job? You need two things. You need a profit, or the motivation to potentially make a profit, and you need capital, because you can't give somebody a job without capital. You have to have tools. Whatever it is, you have to have an office for them to work. They have to have computers, phones, or a machine. They have to have equipment. You need things, because that's what most people lack. Most people who take a job, they just show up. They don't bring anything with them. They don't have their own capital. If they had their own capital, they might not need a job. They would just be self-employed. But the fact is, most people lack any capital because they didn't have any savings, and so they need to find somebody who has capital and who is motivated to make a profit and who's willing to hire them to try to do it. So the only thing the government can do to create jobs is to try to foster an environment where you can create more profits and have more capital, which means more savings, which means the government has to do the exact opposite of everything it's doing. We need fewer regulations. We need lower taxes, which means we need lower government spending, and we need more savings so we can have more capital, which means higher, not lower interest rates, because higher interest rates encourage savings, not the other way around. And these cheap, low interest rates are not benefiting businesses who can't get any money anyway. They're benefiting Wall Street that is speculating, and that doesn't create any jobs. And, of course, yes, is it benefiting the consumer who's leveraging up and buying a house? Yeah, but that is not creating jobs. Refinancing your mortgage and getting a cheap mortgage is not creating jobs. If it did, we'd have full employment right now. We're leveraged up to the hilt. We got interest rates at zero. It does not work. And no matter how many times they try it, it still won't work, because that is the definition of insanity. Doing the same thing over and over again and expecting a different result. The result is not going to change, but the insane people in Washington and Wall Street continue to believe that if we just print more money and keep interest rates lower, that somehow magically it's finally going to work. Anyway, the next caller, also on the hold for a better part of an hour, David in Kansas City, Missouri. David, welcome to the show.
Good morning, Peter.
Morning.
Hey, speaking of insanity, was that Stiglitz that you ran that clip from?
Oh, the Nobel laureate. No, it wasn't Stiglitz. The guy's name was Roger Myerson.
Oh, you think he and Stiglitz and maybe Krugman are have a behind-the-scenes bet on who could say the stupidest thing in public?
Maybe.
Krugman's still ahead, I think, with the space alien thing, but that's pretty close. I mean, anybody that lived through the 70s and thinks that 9% inflation gauged by the government is a good thing, it has to be,
Yeah, for a few years in a row, not just once. We need it consistently.
Yeah. Hey, you opened up talking about the banks and the refinancing, and I've got my mortgage through Bank of America for kind of the same reason that you have your money in Bank of America. But I'm 5 3/4% is my interest rate.
Well, you've got a mortgage. See, you're borrowing money from Bank of America. See, that's different. You don't have to worry about that. If Bank of America fails, that doesn't bother you.
Exactly.
I have money at Bank of America. I've got my corporate checking accounts. I mean, I keep millions of dollars over there to help, fund my business. And the reason I have my millions to keep my company going, I don't keep any long-term savings there, of course, because any of that money I put it in precious metals or foreign stocks or stuff like that. But you got to have working capital. You got to have cash to operate a business. And I keep that at Bank of America because I'm pretty confident that when they fail, the government's going to make me whole, at least with paper money, not necessarily purchasing power. Yeah.
Yeah. Merrill Lynch and Countrywide were too big to fail, though, Peter. You're too small to save.
Yeah. But go ahead.
What I'm wondering about is why do these banks – I get solicited when I go in there to do a refinance. Why are they doing that? They're cutting their own throats.
No,
is it just because they have to compete to maintain the mortgages that they have because they're afraid that they'll get scalped or
as far as why are they asking you to refinance the mortgage that you already have with them?
Right. Is it the upfront fees that they're trying to get? Is it? I mean,
I don't know. Yeah, maybe it is. Maybe they're so short-sighted in their quest for short-term gain that the fee that they generate up front is what they care about, even if long run they've replaced a higher-yielding asset with a low-yielding asset. And, again, a lot of this is the mentality of the management, which is concerned about short-term gain, and they don't really care. Now, maybe it is preemptive. Maybe they know you're getting solicited from other companies to refinance, and so maybe they want just assume keep the business. But again, the reason they even want the business is because they're getting the money so cheap from the Fed. If the Fed wasn't enabling them to get money so cheap, then they couldn't make money with this refi game. But it is not helping the economy. It is depriving the economy of the resources that we really need to grow. But anyway, hey, thanks for the call. I want to see if I can squeeze a few more people in who have been waiting for a long time. Mark in Sacramento, California, you're up.
Hey, Peter, I got a couple of items here, 2 questions. But before I do, I just wanted to point out that on MSNBC this morning on the Daily Rundown, which is normally hosted by Chuck Todd, they had some flunky fill in for him, and they were covering your Senate commercial of the Linda McMahon
today?
brain kick. Yeah, this morning. And The comment was made afterwards. I guess this whole thing with Chris Shays going up against McMahon here at this 2012 election in Connecticut.
Well, McMahon is not a candidate yet, but anyway.
Yeah, I guess, they're just saying that she's going to throw her hat into the ring again, and they were showing her on your commercial. And then the flunky that was filling in for Chris Dodd basically said, oh, and that was Peter Schiff's political commercial when he was running. He barely received any votes.
Well,
so I just wanted to point that out to you.
What channel was this?
That was MSNBC.
Yeah, I barely received any votes. Yeah, I got 23% of the vote in a three-way race. I mean, I barely got beaten by Rob Simmons, who had been in Congress for 20 years, who was the favorite initially to win. And, in fact, I beat Rob Simmons in pretty much every town in Fairfield County. I mean, he mainly beat me because of his own district that he represented. So I didn't do that bad. Considering I got no coverage whatsoever in the media, but that's typical that they would say something like that. Hey, thanks for pointing it out. Somebody else sent me an email today. They saw Jim Cramer on CNBC this morning saying that gold was not a bubble, that it was currency or money, and so it wasn't a bubble, and they were getting worried. Hey, don't get worried. He's just copying me. What Cramer does is he watches what I said. Because I watched him yesterday, and he said that gold was a thermometer of the economy. Now, I just said that on my video blog just the other day. I mean, you think he just came up with that randomly? In fact, if you look at Cramer's his show, he's Cramer because there's a bull market somewhere. He got that from me. I had that on my website as my trademark over a year before he started using it. And in fact, I was on his radio show, and so he was on my website, and it wasn't long after that appearance where I know he was on my website because we were discussing it, that he came up with that tagline. So I mean, he gets his material from me. So I mean, I don't think it's a contrarian indicator. He's watching me, so it's probably a good thing. He just doesn't want to admit that, though.
Okay. Well, anyway, I have two questions or subjects I wanted to bring up, and I really wanted to see what your.
Well, you don't have time. We've got like 1 minute, so quick.
Okay. One, the Libyan sweet crude, $5 trillion worth in oil reserves there. Gaddafi with the African Union, the gold dinar, all this stuff against the fiat currency. And then the other one is Nouri Wabini has gone on attack for the last 72 hours against anybody who's challenging any of the Keynesian economics, and he's been putting in Lagarde, IMF, Gross, Stiglitz, Summers.
Challenging him on what? What is he saying?
They're challenging everything with the Fed. His comment this morning was basically he called Ron Paul's book End of Fed a lunatic. He's just a lunatic.
All right, anyway, well, it'd be interesting. Call me tomorrow when there's more time, because I'd be interested to hear what he actually said. That might have been interesting if you can got that out sooner. But anyway, hey, the show is over. We got a lot of people still on hold. I apologize for not being able to get to the calls. Try again tomorrow. We got another 2 hours coming up tomorrow of the Peter Schiff Show, the gold standard in talk radio. Bye for now.